Okay, fine. We have waited for some time. I think we still expect a few more participants to come, but I guess in the interest of time, we would start this session for today. Good afternoon, everyone, and a very warm welcome from my side, your speaker for today, for on this Digital High Tea Series 2020. As Rödl and Partner has been always at the forefront of organizing seminars, with trade chambers and sessions with our corporation partners. But after the so-called new normal, all the sessions and the seminars had to stop. And then, we basically sat down and thought, what exactly can be done about it? And this digital high tea series is a sort of a result of our brainstorming, where we thought it's really important to keep our clients updated with the recent regulatory changes and the items which really impact their business as such. um, in the entire digital high T series, we basically started with discussing the liabilities of key managerial persons and directors under the Companies Act and other regulations. Then we moved on to a very interesting topic on transfer pricing, where we discussed what happens when there are delays in payments to your overseas holding companies and associated companies from a transfer pricing and regulatory perspective. Then in the last session, we discussed a very interesting topic on permanent establishment in case of commission contracts and marketing and sales support services, which was taken by my colleague Chetan Kakaria. So going along with the theme of the series, today we will be discussing about schemes and incentives under the customs law and the foreign trade policy for undertaking manufacturing in India. This is more of a general topic in terms of trade, but a very interesting topic because it is largely ignored by a lot of companies. They really, don't figure out what exactly are the incentives and benefits that they can really claim under the foreign trade policy as well as the Customs Act. So we will discuss these particular schemes, and in case you have any questions regarding any of the topics, please feel free to put them in the chat box. And after the end of the session, we will try to take as many questions as possible. Even in case we are not able to answer any specific questions, then I would request you to kindly send me an email, and I would certainly try to revert back to you as quickly as possible. So with this, in order to avoid the lag due to internet, I would now put off my webcam, and so that all of us can focus only on the presentation, which I'll start to run now. Good. All right, so going on and proceeding with the topic for today, what exactly is the agenda? So what we would be discussing are the schemes, as I mentioned, on the foreign trade policy side, as well as on the customs side, which typically include MOOR, which we call manufacturing and other operations from the warehouse scheme. We would also discuss about project exports. We would also discuss about EPCG and advance authorization, MEIS, as well as some other schemes such as AEO, and the relevant topics which are connected with them. I don't know what's happening to this. Okay, I'm having some issues. Right. Yeah. Okay. So coming directly to the topic, what we need to really understand nowadays is that we are living in a very, very dynamically changing environment. There are so many things which are happening around us, and many times we are not able to comprehend the impact of these changes on us or on our business. For example, we all know about the ongoing US presidential elections and the uncertainty which is surrounding it. I mean, what if Trump gets elected, or what if Biden gets elected? What would be the impact of the new president on the India-US relationships, or as a matter of fact, on the India-China relationships? We all know that like past 4 years between US and India, we've seen our ups and downs, where we came very close to a smaller version of a free trade agreement. It's still being discussed, but at the same time, US had also alleged that India is a tariff king, and we have so many customs duties on all our imports. Very, very famous case being customs duty on Harley Davidson motorcycles, which made the news very often. But yes, all these things have a really big impact on our businesses. And in case we really want to focus on more local items which made news in this COVID-19 period, I mean, we got to hear a situation where where our Commerce Minister, Mr. Piyush Goyal, talked about redemption of free trade agreement talks with EU as well as with separately with UK after the Brexit. So what we know of is certainly India is pursuing aggressively the free trade agreement with UK as of now. A few items need to be ironed out, and certainly the discussions are supposed to again resume on the India European Union free trade agreement. My view, obviously, is that this would be a big game changer to our clients and the people who do business and trade between Germany and India. This is certainly which made a big news, a big impact. At the same time, we also heard about shipments from China into India, which were made liable to 100% examination, which led to a big time disruption in supply chain. All the consignments from China were held up and were subject to examination, and took days and days for some companies to clear goods from China. After that was resolved, and as if it was not enough, they came up with Karotar rules. We will discuss it in later part of the session. And also they introduced faceless assessment under customs law very recently, which now means that if you import your consignment, say for example in Mumbai, the officer who is going to do the assessment would be sitting somewhere else, could be in Bangalore, Chennai, or any remote part of India. And this person would undertake the assessment, ask for questions, and eventually given out of charge. All these changes resulted into again a big issue from a supply chain perspective. In the last few months, a lot of our clients have complained that the clearance time has gone up by 20 days. So their shipments are at the port for 15 to 20 days. There are no containers, there are no officers, they don't know who to respond and who to go to. So I think these are all issues which we are facing as on today, including the uncertainties related to policies. For example, we still have a situation where the foreign trade policy, which got lapsed in March 2020, got extended by one more year to March 2021, and we still don't know what's going to happen after April 2021. It's only 4 months to go. Still, no policy has been announced. So all these things, along with the COVID situation, has really, created a lot of jitters down a lot of Indian companies. Uh, with, but with this, also one thought which comes to our mind is that, if we are facing so many disruptions, we should also evaluate what are the areas and benefits which we can really take as a company who is undertaking manufacturing in India. So, from one side, while yes, we have issues, but at the other side, if we really don't take the advantages of the schemes which are available to us, I think it's a double whammy to for anyone. So let's look at what exactly are the schemes which are available. We'll go one by one and look at the schemes which would be available to you. These in the current slide, you can see that we have broken them down into three basic parts or three different categories. First category being an exemption or a deferment based customs duty on import of goods. So these are schemes wherein you can really take an exemption or a deferment on payment of your customs duty when they come into India. We would be largely focusing on the customs bonded warehouse scheme, which is the recent latest scheme, which was introduced last year in October 2019, and did not get a lot of limelight because of the current situation. And the others, which are EOU, advanced authorization, and EPCG, I would certainly not be spending a lot of time on these because these are the old schemes, and then we certainly don't know about the future of these schemes after the India-US case, which is right now ongoing in WTO. In the second bracket, we can see that we will be discussing certain post-export incentives. These are the benefits under the foreign trade policy. And so here we'll be discussing about duty drawback, MEIS, which most certainly would go away and would be replaced by RODTEP scheme, which is a remission of duties and taxes on exported product. And thirdly, we would also discuss about the AEO scheme. I'll be again focusing quite a lot on this particular scheme under the customs law, which basically deals with trade facilitation measures. So in short, three of the more important elements out of the entire bucket would be the customs bonded warehouse scheme, the RODTEP scheme from the second bucket, and the AEO scheme from the third bucket, where we will be focusing more upon, which we believe are the future of benefits or the exemptions which a manufacturing company, or as a matter of fact, some other companies can really obtain under the customs and the foreign trade policy. Good. So now we move to the first scheme of customs bonded warehouse. And before I really go into the scheme, I would like to give you a small perspective of from where we are coming or why this scheme was basically brought in. So in March 2018, US had filed a petition against India in the WTO, World Trade Organization, saying that a lot of the schemes which are notified under the Indian foreign trade policy, they are inconsistent with the articles 3.1 and 3.2 of the SCM agreement. SCM agreement is the subsidies and the countervailing measures agreement, which all the WTO members have signed. And depending on their GDP, they are allowed to roll out certain schemes to businesses within their countries. And after almost evaluation of 1.5 years, there was an order which came in October 2019. Oops. Right. Am I audible, Zehra? No.
Yes, you are.
Right. Sorry. So something happened. I'm sorry for this disruption. And the internet. Okay. Can we go to the next slide? Can I? Okay. Please go to slide number 8 there. I can't control it from here anymore. Yeah. Right. So I think Zara, you'll have to control from here onwards because I have
Yes,
lost.
I'm helping out. It's okay.
Okay. So what happened in October 2019 was that the panel submitted its report, and basically US won this particular round against India, and it was held that the DFIS scheme and the EOU, EPCG, MEIS, Advanced Authorization, and SEZ scheme, all these schemes are against the Article 3.1 and 3.2 of the SCM agreement. And India was asked to discontinue these schemes within a period of 90 up to 180 days. This was a big sort of a setback for the Indian government, and therefore they basically have appealed against this particular order in WTO. But interestingly, they also started to work upon parallel schemes which would replace these particular schemes in the future. And the major element which they brought out was to allow companies to set up customs bonded warehouse within their existing factories, and to allow manufacturing and processing activity to be carried out from these customs bonded warehouse. So to give you a small perspective, customs bonded warehouses were earlier only of two types. One was a private bonded warehouse and a public bonded warehouse. And in a private bonded warehouse, you were only allowed to store the goods. And when you cleared the goods from the bonded warehouse, you had to pay the customs duty. But now with this scheme under Section 58 and Section 65 of Customs Act, what they have said is that you can convert your existing factory into a customs bonded warehouse under section 58, and at the same time you are allowed to undertake processing and manufacturing activities from these bonded warehouses in India. Next slide, please, Zara. Good. So this is a small diagrammatic representation of what exactly happens in the customs bonded warehouse. What happens? So when you would import goods into India, these goods would be raw material. These goods could be capital goods. These could be components, but with an intent to undertake manufacturing in India. When you import them, the goods come from the port into your factory under a one-time lock and key. There's a process that they have already defined how the goods would move. And when the goods come into your warehouse or your factory, you will not be required to pay any customs duty, including basic customs duty or social welfare surcharge. In fact, even the IGST payable on the import of goods is also deferred. So in short, you don't have to pay any customs duty when the raw material or the capital goods, both goods come into India. Now, when, for example, you manufacture your finished products and you export these goods from India, then obviously again you don't have to pay any customs duty. The entire duties payable on the import side are waived. So in a sense, this is like an EOU scheme. But the interesting part would be that under EOU, you are, for example, required to mandatorily export 100% of your manufacturing with a certain allowance for DTA clearance subject to NFE requirements and other procedures. But here, any company, whether you have exports or not, you may have zero exports, you may have 100% of your sales to customers in India, you can still apply under the scheme. You can take the benefit of the deferment of customs duty. All the goods that you import into India will be stored into your warehouse. They will be stored without payment of customs duty. There is no time limit for you to use those goods or use them into manufacture. They can continue to stay there. You will use them for manufacturing, packing, labeling, or any other process as you may want to use them for. And in case, as I said, if you export them, no customs duty payable. But in case you sell them locally, for example, to your customers in India, then you will have to pay customs duty, which you saved when the goods were imported into India. So in short, you don't have to pay customs duty on your sale price, but you have to pay actual customs duty which was saved on these goods which were used for the purpose of manufacturing in India. Next slide, Sarah. Right. So here I have just outlined some of the important benefits under the scheme. So you, as I mentioned, that when you import raw material and components for the purpose of manufacturing in India, no customs duty or IGST is payable. It stands deferred. In case you import capital goods for manufacturing in India, again, no customs duty or IGST is payable. This is a big cash flow benefit, because in case you are setting up your factory, or in case you are doing a significant expansion, you don't have to pay customs duty, which is a big cost and a big cash flow effect for a lot of companies and manufacturers in India. So all these duties stand waived, and when you basically do domestic clearances to your customers, you only have to pay the customs duty that you saved on the raw material. No customs duty payable on any portion of capital goods. You have to just do one-to-one tracking of raw material used for finished products and pay customs duty only on that aspect. No interest is applicable on such sales, and you are, as I mentioned, you're allowed to keep those goods for any amount of time in your factory. I mean, this is a very practical point. A lot of people and companies in India, they import material for manufacturing. A lot of it is, slow moving inventory. It is used over a period of 1 to 3 years. Capital goods are used for a period of 10 years. They, lie in your factory forever. So there is no time limit. You can keep storing them for n number of years. Once you take the license, you don't have to renew it unless you go in for a cancellation. The license would be valid for perpetuity. There is no specific additional compliances that you have to do. You can convert your existing factory existing business premises where you have your manufacturing setup, that can be also converted to a bonded warehouse by making an application. And you can do it anywhere. I mean, like for example, in SEZ, we have an issue that you have to open your SEZ unit only within the SEZ premises. There is no geographical restriction here. You can take any location and convert that into a bonded premises. Now, when we stop here, you would maybe ask, what is the difference between maybe, this scheme and an EOU or an EPCG or an advance authorization, which we'll deal later also. But then, the important part here is that all these schemes in existence are mostly focused towards exports. In case you don't have any exports, you cannot go for an EOU or an advance authorization or an EPCG. But here, in case you are a 100% DTA supplier, you can still go for this scheme. And there are no export commitments, no export obligations, no minimum value addition requirements. You can be a low risk manufacturer, a very basic manufacturer doing only 10 to 15% value addition. There is no commitment for earning foreign exchange into India. The customs authorities will not depute anyone for physical supervision or inspection at your premises. This is mostly a trust-based scheme. You don't have to pay any application fee. There is no compliance fee, no extra cost involved apart from a small compliance form that has to be filed. And you are also allowed to continue with any other facility like AEO that you may be obtaining. So it's in short a replacement to all these schemes which are currently in existence, where the future is really under question. Next slide. Good. So what are the requirements for you to convert your existing factory into a customs bonded warehouse? First of all, obviously being a bonded premises as such, your facilities, your equipment, your personnel, it should be sufficient to control access to the warehouse and to provide a secure storage for the goods within the bonded premises. So these goods are certainly duty free, and being duty free goods, customs would like to really ensure that there is no pilferage, there is no theft of material from this premises, and therefore they would only like to ensure that you have sufficient secure storage and you have certain facilities by which you can really control the access to this place and also control the pilferage or theft basically from this premises. So they basically would look at whether you have a burglar alarm system, whether you have a CCTV facility. If you have CCTVs, how many CCTVs, where exactly are they located, for what period do you have the recording available with yourself, whether there are sufficient fire security, which is the security agency appointed by you, whether it is for 24 hours or not, etc. So in short, they would really like to evaluate whether there is sufficient security in terms of storage of the goods. There was a very interesting question which was asked in one of the FAQs issued for the scheme, that whether my factory premises needs to be closed from all sides, whether it needs to be locked, it needs to be secured from all four directions by walls, etc. And it was very clearly clarified that no, you may have a manufacturing facility which requires you to have some facilities outside the building, and your facility may not be closed from all four sides, but till the end you have sufficient security features within that particular area. Still the license should be given to such factories. So it's a very open-ended scheme, and it's basically you have to prove to the customs authority or the officer who comes for physical inspection of your premises that you have sufficient security features available in your factory location. At the same time, with the application, you really need to submit your ground plan, what would be the area which would be used for storage of duty free goods, what is the office area, etc. What is the security features, when was the building built or remodeled, etc. So these would be some other requirements that have to be submitted along with the application. Next slide. Next slide, Zara. Mm. Zera, can you please change the slide? Right. Fine. Good. So this was in short the customs bonded warehouse scheme, and I think as I mentioned that this would be the future of the EOU scheme as well as the EPCG advanced authorization scheme. While we will quickly cover these schemes in the next few slides. EOU scheme, we all know essentially is for exports and for earning foreign exchange in India to attract investment in export production. And as an EOU unit, basically you are allowed to import goods, raw material, etc., duty free, including second-hand goods, and they can be stored in your premises for 3 years. You get a permission for 5 years. You are also allowed to procure goods from locally within India, and these supplies qualify as a deemed export under GST, for which either the EOU unit or the supplier of to EOU unit can claim a refund. Um, and then you also get certain exemptions from industrial licensing and additional depreciation on capital goods. Next slide. So on an EOU side, what are the requirements? The requirements is that you need to have a minimum investment of 10 million INR in plant and machinery, and that these should be used within a period of 3 years. So you have a clear-cut storage period that your raw materials, spares, and consumables have to be used within a period of 3 years. If you don't do that, you don't use them within 3 years, you have to pay the customs duty, which you claimed as an exemption at the time of import, with interest after the end of 3 years. At the same time, when you import capital goods, you need to install them within a period of 1 year from the date of import. If you don't do that, again, customs duty becomes applicable on capital goods. From an export obligation perspective, an EOU unit needs to be a net positive foreign exchange earner. That means when you export goods and you earn foreign currency, and when you import goods, you pay foreign currency. At the end, the EOU unit should have net positive foreign exchange earnings in India, and these would be basically regulated and calculated over a period of 5 years. And in case you are unable to do that, certainly your LOP can be cancelled. It will not be extended, and only in case such things have happened, you have to apply for with the authorities for genuine hardships within the period of 5 years, and the board of approval can basically then take a call whether they want to extend it or not. But in short, EOU unit or EOU benefit is, as I said, it's the future is under question. Under the GST law, we know that supply of goods to EOU units right now qualifies as deemed export, but this benefit is only up to March to 2021. They have already extended it for a period of 2 years. They keep on extended only for a period of 1 year every time, and therefore, all the units who are under EOU are always under this policy paralysis. They are not certain what will happen to the on this specific benefit after the end of 1 year. Next slide. Good. Advance authorization. A lot of our clients have already gone for this scheme. Advance authorization basically allows importers in India to import raw material without payment of customs duty, and these goods have to be used for the purpose of manufacturing, and these manufactured goods need to be exported from India. And there is a minimum value addition requirement. There should be a minimum value addition of 15 to 20%, depending on the nature of the material that you are importing. And then you have the procedures of obtaining redemption and closure of advance authorization, which every company or every applicant needs to go through. The important element to note here is that there is a minimum value addition requirement. A lot of companies in India are unable to fulfill it. At the same time, you have a huge compliance which comes up at the time of redemption. Redemption, I mean, at the time of cancellation of the advance authorization. And therefore, slowly and steadily, this particular scheme is losing its steam. Next slide. Right. So coming to EPCG, again, an old scheme, a lot of people know about it. Like advance authorization allows you to import raw material, EPCG allows you to import capital goods without payment of customs duty. Basically, again, the exemption is subject to export obligation. You don't have to pay customs duty or IGST at the time of import, but at the same time, the scheme mandates that you have to export goods 6 times of the duty saved within a period of 6 years. So we've done a small computation which you can see on your screen, that in case you import capital goods worth 5 million INR, the duty saved would be 138,000 rupees. Exactly what you have to pay is zero, but what you have to really do is you have to export goods worth 8 million INR minimum in a period of 6 years, and then go in for a redemption and cancellation, which again is quite similar to the advance authorization scheme. And therefore, as I said, again, due to the inherent compliances, very heavy compliances under these two schemes, a lot of people really think before going under the AA and EPCG. Next slide. Right. So here we have given a small comparison about the 4 schemes which we have discussed till now. Between Moore, EOU, EPCG, and advance authorization. So we have a situation where which scheme is better and which scheme really should be opted going forward for any company or a manufacturer in India. So let's look at each element one by one. So first benefit is whether you get a customs duty exemption or a waiver on import of inputs. That happens in all the 3 schemes except EPCG. Obviously, EPCG is related to capital goods, and therefore in the second scheme topic or second bullet, you can see we talk about customs duty exemption on import of capital goods, which is there in all the other schemes except advance authorization, which deals with raw material. So here these 4 schemes almost are equal, which give you an exemption or a waiver from customs duty. On the IGST side, EPCG and advance authorization are equal to Moore for the time being, and for EOU again you have this exemption, but only up till March 2021. As I mentioned earlier, we are not very certain about what will happen to this particular exemption going forward. But the next few line items are really where the why Moore becomes a very a game changer specifically, is because what exactly is your obligation to get this benefit? What do you have to do to get the benefit of customs duty waivers? In EOU, in EPCG, in advance authorization, you have a specific export obligation. So if you are not an exporter, you cannot go for these schemes. While in a Moore scheme, there is no export obligation. If you are a 100% DTA supplier, you will still get this benefit. No customs duty payment required when you import goods into India. The validity of the license under Moore is unlimited. Once you take it, you don't have to surrender. Unless you surrender it, it is applicable for a lifetime. While EOU is applicable only for 5 years, you have to go in for an extension later on. EPCG advance authorization is for 2 years, 1 year, respectively. There is no time limit for storage of your goods. You can store them for any number of years. While for EOU, obviously we can compare it only with EOU. You have to use them within 3 years for raw material, and for capital goods, you have to install them within 1 year. In terms of other compliances, do I have minimum value addition or an NFE requirement? No such requirement under Moore, while you have a positive NFE requirement under EOU, and you have an export obligation under EPCG, and minimum value addition requirement under advance authorization. Whether you are allowed to do trading of goods from the warehouse, yes, you are allowed to do trading, but in case you import goods into India for the purpose of trading, then you do not get the benefit of customs duty waiver. You can only store these goods for a period of 90 days. In case you store these goods beyond a period of 90 days, which are meant for trading, then customs duty and interest becomes applicable. So this is a small catch for manufacturers who do manufacturing as well as trading, that when they bring goods into India, they need to really, segregate them into goods which are meant for manufacturing, which are raw material, where you can really claim the benefit of customs duty deferment. But at the same time, if you are importing goods for trading, then we normally are suggesting our clients not to take this benefit of customs duty deferment and bring these goods on payment of customs duty, so that you don't have any challenge later. Good. Then in terms of actual user condition and SIAN norms, again, more stands out as compared to other schemes. Next slide. Good. So this was mostly about Moore. As I said, this is the future of benefits and under the customs law for India, and every manufacturer in India really, should look at this particular scheme. A few facts and figures for this scheme for you, that in India there are not a lot of companies who have gone for this scheme. The Indian government has partnered with Invest India to promote the scheme, and a lot of the elements of application and everything are online. The only physical interaction would be when the customs officer would visit your factory premises for inspection to check whether you have sufficient security features or not. Apart from that, during our last interactions with the authorities, we were told that there will not be regular audits for your shipments from the port to your factory, or from your factory to your customer, or from your factory to another bonded premises. There will be no requirement of a permission from the bond officer or from any customs officer. You only have to follow the process of one-time lock, which is already given. And the issues basically is that you have to basically file more bill of entries. I mean, right now when you import goods, you file directly a bill of entry for home consumption, but here you have to first file bill of entry for warehousing, and when you remove goods to your customers or sell goods to your customers, you have to file a bill of entry for ex-bond clearance of goods and pay customs duty. So a slight increase in compliance cost can really give you a large amount of added benefits in terms of cash flow. Cash flow is in the minds of all Indian companies right now, how to improve your cash flow situation. And I think this is a very good answer to it. Coming to the next scheme for manufacturers, we've already discussed that in case you are supplying goods to an EOU unit, then this qualifies as an deemed export under GST. It also qualifies as a deemed export under the foreign trade policy in India. So all DTA suppliers supplying goods to EOU schemes or STP holders or EPCG license holders or advanced authorization license holders, or if you are a main contractor or a subcontractor wherein you are supplying goods on installation services for projects which are financed by multilateral agencies or Department of Economic Affairs, or it's a internationally funded project by UN, or it's a specified power project. In all such situations, your supplies to such agencies or such companies would qualify as a deemed export. What are the benefits that you can claim as a deemed export? Because this is basically knowing about your customer, to whom are you supplying. So please go to the next slide, where we basically will discuss that in case you are a deemed export supplier, then what are the benefits that you can really take apart from the GST benefit that we have already discussed, that if you supply to an EOU or an EPCG license holder, it's basically qualified, would be qualified as a deemed export, and you as a supplier can take a refund of the GST that you pay on such supplies in case the EOU unit or such agencies with whom you are dealing, if they decide not to take the input tax credit of the GST charged by you on your invoices. So in case you charge GST and they take an input tax credit, the EOU unit takes an input tax credit, then no one gets a refund. In case they decide not to take an input tax credit, then you as a supplier are allowed to claim a refund of the GST paid on the invoices. So this is certainly one of the benefits. Apart from this, you also can claim a deemed export drawback for basic customs duty. So all the goods that you supply to, for example, EOU unit, in case you have used inputs which are imported for manufacturing of such goods, you can claim a deemed export drawback from the DGFT authorities. and this has to be done based on the brand rate. So you have to give them documentation proving the goods which were used for the manufacturing of such finished products, and then you basically get a refund in the form of duty drawback. Um, there's also a benefit of terminal excise duty, which was earlier quite important, not anymore, because now we have very few goods which are liable to excise duty, which are mostly petroleum products. So only if you are a supplier of a petroleum product, you can, rather go in for a refund of the terminal excise duty, which before the GST regime was quite important, but now is rather not that important. Yes, next slide. Good. So these were the basic schemes under the customs law, which were pre-import benefits. Now we go on quickly to post-export incentives. First, next slide. We go to duty drawback. We know about duty drawback. Again, it's a old scheme. Most of us are aware of it. And the duty drawback can be basically looked at it from two perspectives: Section 74 and 75. Next slide, Zara, please. And Section 74 basically deals with duty drawback for imported goods which are exported as such. So you import something and you export them as it is. In such a situation, you can get a refund of 98% of the customs duty that you have paid on the import side. In case you have not used them. In case you have used the goods over a period of time, then the amount of customs duty refund keeps on reducing. So Section 74 deals with traded goods, and Section 75 of the Customs Act, or the drawback, deals with goods which are imported for the purpose of manufacturing, and the manufactured goods are then exported from India. So you can claim a duty drawback within a period of 3 months from the late export order, and the drawback is available under two different setups. First setup is an all industry rate. So there's a big schedule which is available. You have to look at the HSN code of the material that you're exporting, and based on the FOB value of the material exported, you can simply look at the duty drawback schedule, and there is a percentage which is normally given for every type of material which is exported, and basically ranges from 1.5%, 2% to 5%, and you get a drawback of that particular percent on the FOB value of your exports. There is no specific application for an all industry rate. You can endorse your shipping bill itself and claim a duty drawback in case of an AIR. But in case you feel that the all industry rate does not cover the customs duties that you have paid on your inputs, you can certainly apply to your jurisdictional customs officers, and then they will calculate a brand rate of duty drawback for you, where you will basically have to submit what are the inputs that you imported, what was the total customs duty that you have paid, which is more than the all industry rate, and then they will fix a rate for you and give you the duty drawback of the exact customs duty that you have paid on the inputs which are exported. Next slide. Good. MEIS is something which we know is going to go from 1st January 2021. This is a scheme which was brought in for promotion of exports on notified goods, and the MEIS is given in the form of a scrip which you can use for payment of customs duty on the import side. You can use it for any other fee, etc., or you can also transfer the MEIS scrip to any other person who is an importer. It is freely transferable. You can sell it in the market for a discount of 2 to 3%. Normally can be sold very quickly. This scheme gives you a benefit of between 2 to 7% of the FOB value of your exports. But as I said, this is going to be discontinued from December 2020. In fact, there's a circular trade notice which has been issued where they have capped the MEIS benefit for all exporters for every IC holder up to an amount of 2 crores INR, Indian rupees, for the shipments between September and December. So you cannot get an MEIS more than INR 2 crores for all your exports from 1st of September to 31st of December. And with this, they have really laid down the way forward for MEIS as well as SEIS. They have already started consultations with the trade bodies. Recently, the discussions were started with the electronics industry for determining the RODTEP rate. as well as the SEPC, which is the Service Export Promotion Council, has already reached out to all the service exporters to determine the ROTTEP rate for exporter of services. So this is a very short-lived scheme for sure. Next slide. Yes, so we've already talked about ROTTEP. ROTTEP would be a WTO compliant scheme where you would get a reimbursement and benefit of all the taxes which are paid on your imports, on your local procurements. For example, under GST, you have many credits which are not available to you, like rent a cab, or on insurances for your employees, or on construction services. Similarly, when you buy electricity, you know that on electricity purchase you have something called as an electricity duty, which is as high as 20% on your power purchases. Again, it's a duty which is non-creditable. Then you pay stamp duties on your leaves and licenses agreement. You pay stamp duty on your share capital. All of these duties are non-creditable and become a tax cost to the purchaser. So the ROTTEP scheme's intention would be that all these taxes which become a cost to the exporter would essentially be refunded back to him, and this would be done based on a sample calculation of a few companies which are selected by the trade bodies and by the export promotion councils, and they would essentially again come back with a rate for each and every sector, which would be to again nullify the effect of taxes which are embedded on the purchases for goods which are exported. Next slide. Good. With this, we have completed most of the duty deferment and duty incentive schemes. I would quickly like to go to the authorized economic operator scheme. This is a very interesting scheme which is there for many years. It's a WTO compliant scheme. Next slide, Zahra. And this basically does not give you any incentives as such, but it really gives a lot of benefits in your supply chain. So in case you have more than 25 bill of entries or export declarations, you can go in for an authorized economic operator scheme. This basically, the requirements here is that you should be in operation for the last 3 years. Generally, it is not given to a newly set up company. But once you have gone in and have businesses for 3 years, you can get this license with subject to a minimum bill of entry or shipping bills of 25 in a particular financial year, and that you should not have any show cause notice for any fraud, forgery, or there should not be any case of prosecution against your directors. So in case you comply with these requirements, then you can certainly apply under the AEO scheme. Next slide. So what are the benefits that you get under the AEO scheme? First is that see, this is a safe framework of standards which are adopted by all WCO members, and this basically is a facilitation of trade between various WCO members. That when the material moves, say for example from Germany to India, you should basically give them benefits in terms of quicker customs clearance. There should not be any hassles. The compliances should be reduced, and therefore a person who is authorized economic operator basically will get a facility of a direct port delivery, direct port entry, and this because of all these things, you can essentially ensure that your cargo gets cleared within a period of 48 hours, and therefore you don't have CFS charges. So essentially, this is more of a supply chain benefit where you get a preferential treatment over others. You are allowed to submit paperless declarations. You don't have to submit a lot of supporting documentation. You get a lot of other benefits. For example, you get something called a deferred customs duty for T2 and T3 categories. So I'll just quickly run you through what is T1, T2, T3. T1 is a category which is the first category where you have an online form and a minimum documentation where you get some of the benefits under the scheme, including DPD and direct port entry, as well as paperless declarations, 24/7 customs clearance, and deduction in terms of bank guarantees. For example, you only have to give 50% of the amount of bank guarantee as compared to others under the T1 category. Once you have done business for some time under T1 category, you can apply for T2 category. Under T2, there is a physical inspection involved, and you also have to submit again similar paperwork like we discussed in the bonded warehouse scheme on security features of the goods. And once you have done that, you can be categorized as T2, and this gives you a lot of additional advantages, like you get a client relationship manager at each and every port. You get ID cards for direct entry to your ports. You have speedy disbursals of investigations, dispute resolutions. Quicker drawbacks and refunds are given. And you have a single point of interaction, as I mentioned, in the form of a CRM, which is would be a level of assistant or a deputy commissioner. So all these benefits would be available once you classify as a T2 category. And then T3 would be like the top end of the hierarchy, where all your suppliers and all the people who are involved in your trade are also categorized as T3. So this is like the fag end. A lot of people have not gone for T3 because T2 essentially gives you most of the benefits. And we have around, I think the last number that we have is around 4,800 people. Companies have already gone for the AU scheme and are getting preferential treatments as compared to other importers. Next slide. Good. So here we have just given a small application process, which we can discuss later if you are interested in this scheme. Next slide. Next. Good. So quickly, I just, in the interest of time, I'll take 2 minutes on why, we really, every company in India should really think of manufacturing. In the last few months, there have been a lot of, news articles where the government is trying to create barriers for import of finished goods in India. You must have heard about, tariff barriers and non-tariff barriers. Non-tariff barriers we'll discuss in the next slide. But in terms of tariff barriers, they have increased the customs duty for finished products while reducing the customs duty on raw material. A long time example of this would be motor cars, motor vehicles. So if you import car in India in a fully constructed form, customs duty is 110%, while if you import it in CKD form or raw material, customs duty is 10 to 15%. Therefore, clear intent that you should set up a manufacturing facility in India. They are going in this direction for a lot of other products as well, where the customs duty rate for finished products are being increased, while the customs duty rate on raw material used for manufacturing has been reduced. They are also bringing in, additional duties, anti-dumping duties, safeguard duties. Yesterday, there were 3 notifications on anti-dumping duties for various products. Again, which are in the form of finished goods, thereby again trying to restrict import of finished goods in India. And at the same time, we all know that if you import finished goods, obviously they are of a higher value as compared to raw material, which will be of a lower value. Thereby, in the overall supply chain, the customs duty cost will be much lower in case you are importing raw material as compared to finished goods. Next slide. And now, in my last slide, I'll just quickly take you through non-tariff barriers. Why you should, really look at manufacturing again is we have heard about additional licensing for many goods. In the last August, I believe there were news articles on electronic goods, on toys, furnitures, that the government would really plan to bring in additional licensing for all these products. You have to go in and apply, and you will be allowed to import only a certain quantity of these goods into India in the finished form. So they might bring more and more such goods into licensing, specifically if they are being imported from countries where India has a negative, balance of trade. Then they are also bringing in a clear prohibition for import of goods. Very recently, as you know, air conditioners were prohibited from imports. Televisions were prohibited from imports last year, and slowly and steadily they are bringing more and more material into the category of prohibited list, and also increasing inspection for finished products in India. Yes, so this was why we believe really that setting up manufacturing in India is really the way to go for future, to improve your trade, to improve your business, to really save on customs duty and become more and more efficient from a business perspective. Next slide. I'll not discuss free trade agreement right now in the interest of time, but we can. This is not really linked to manufacturing in India. It is just a simple comment which I would like to make, that India certainly does not have a free trade agreement with EU or with the UK right now, but it may happen in future. In case that happens, this is certainly something which needs to be evaluated. But at the same time, in case your organizations have manufacturing facilities in other countries like ASEAN nations, or nations like, which who are the signatories with India on Mercosur free trade, located in South American region, then you should really look at structuring your supply chain from a perspective where if you import goods from these countries, you can claim benefits under the free trade agreement and reduce the customs duty applicable on the import of such goods in India. Yes. Next slide. Good. So with this, we basically will stop the session for today, and I would take any specific questions that maybe Zara, do we have any specific questions on the topic? Then you can certainly send it to me right now.
Yes, we have some questions.
Okay, let me look at them. Okay, so first there's a question on clarify whether private company making arms and ammunition for which they are granted permission from Ministry of Defense can obtain in-bond manufacturing scheme. Yes, you can certainly apply under the in-bond manufacturing scheme in case you have obtained permission from the Ministry of Defense. There is right now under the scheme no clear restriction on who can apply and who cannot apply. There will certainly some doubts which were raised in one of the FAQs, whether being under a bonded premises, whether we have to obtain such permissions or not, which was clarified saying that all the other permissions which are required for import of goods into India should be obtained at the time of import of goods itself. So I think that answers your question, that you have to take these licenses, the other permissions, and you are allowed to operate from the bonded premises for all these goods, and there is no no list of items which are prohibited for obtaining under the warehouse scheme. Okay, so next question is customs bonded warehouse scheme. While I understand from you that customs duty on raw material and component can be deferred till you sell the goods that use the material, I did not understand when the customs duty on capital goods has to be paid. So customs duty on capital goods is not required to be paid unless you clear the capital goods from your factory. So if you import capital goods into India under the customs bonded warehouse scheme, you don't have to pay customs duty or IGST. The goods would be installed in your factory and they will be lying there till the time you're using them for the purpose of your manufacturing. Now let's say after 10 years, the capital goods have lost their value. There's nothing left. These goods cannot be used. So in case you decide to sell the capital goods to a person located in a DTA, you remove the goods after 10 years to a customer in India, then you have to pay customs duty on the original value of capital goods that you had imported. In case you send the capital goods back to your supplier or you export it from India, then you don't have to pay any customs duty at all, because the capital goods came into India and then the capital goods got exported after use. So there is no customs duty applicable. Only in case you sell the capital goods or remove the capital goods in India to a customer, then you have to pay the amount of customs duty that you originally saved. So you don't get the benefit of depreciation. For example, in UU scheme, you get the benefit of depreciation for every quarter that you use the capital goods, and therefore customs duty liability reduces. But in Moore, that benefit is not available. You can use it for n number of years, and only when you remove it, you have to pay the original customs duty that you saved. Next question is, in case of a trader, Can he also defer payment of customs duty till he sells the goods? I think that I have already answered, that you don't get the benefit for deferment in case you are a trader. You only can store the traded goods for a period of 90 days, after which the interest meter starts to tick. And therefore, what we recommend our clients is that you should really, segregate the goods at the time of import itself. In case you import raw material, certainly take the benefit. But in case you're importing traded goods, goods for asset removal or goods for trading in India, please bring them on a duty paid basis. You're allowed to store the goods within the bonded premises for an n number of time, n number of years, but these goods should be duty paid goods, because you don't want to end up paying interest on goods which are then meant for trading in India. So this should really be ensured in a bonded premises scheme. Next question is, in case of bonded warehouse scheme, how does the government ensure that the importer has paid customs duty on all imports within whatever time is allowed? Example, if I import material on 1st Jan and do not consume it at all for say 10 years, can I defer payment of customs duty for 10 years also? Yes, this is the point, that if the raw material is with you for a period of 10 years within your factory, you don't have to pay customs duty for 10 years on these products. It basically is a deferment. It is not an exemption. You have to understand that whenever you are removing something from a factory, that means at that point in time, the goods are coming into India, are becoming a part of India. Therefore, only at that point in time, you have to pay customs duty. The way they will track it is through your periodic returns. And, you have to basically file some certain forms, which basically gives the details of the imports on one side and the supplies on the other side. And then every maybe 3 years or 5 years they may come for post clearance audit, which anyway every importer is liable to a post clearance audit. Here maybe the periodicity of audit may increase, but till the time you have a good IT system or a good system to track that the imported goods duty free are still in your warehouse, and they have not left, they have not been used in finished products, then there is no customs duty liability at all. After 10 years, you can actually, if it is a slow moving material and you are not able to consume, you can actually export it back to your supplier or sell it to someone else outside India, and then again you don't have to pay any customs duty. So this is the main benefit here, that anything and everything which is there in your warehouse, there is no customs duty applicable on it. Next question is, I'll just take this last question because we don't have much time, and if you have any other questions, you can please send it to us. In Moore, is there any input-output ratio that you have to show between input material and the finished product? I think this also I answered, that there is no minimum value addition. There is no minimum export obligation. What you have to really show and disclose is self-declared SIN. Self-declared SIN means you have to submit to the customs authorities at the time of application itself, that for each finished product, what are the inputs that are required for the purpose of manufacturing, basis which you will be paying your customs duty. So let's take an example that you have 3 finished products in which you're dealing, and for finished product number A, you require 5 products on your BOM, and for B you require 7, and for C product you require 10 products, 10 raw material. You have to give this information to the customs authorities, and then basically when you are selling the goods to your customers, you have to really do a one-to-one calculation, that for when I sell a product A, 5 of my raw material were used for manufacturing of this product A, so I have to pay customs duty on these 5 products essentially. Similarly, on B, you calculate the customs duty based on the 7 products or 7 raw material which are used for manufacturing of this product B. Based on this, so this is not determined by customs. This is not determined by any other authority. Like in the case of advance authorization, you have to go to the board of approval, and they will notify your SIN, standard input output norms. Here, it is self-declared. You have to tell the customs what are the inputs that you will require for finished products, and basis on this declaration, your customs duty will be calculated and will be discharged when you sell the goods to your customers. Good. So I think with this we have completely ran out of time. I would really request, in case you have any other question, do send it to us on my email ID. It is there on your screen. I'll be happy to come back to you with any other question in case you have in terms of any of the schemes that we discussed today. I thank all of you for your participation and patient hearing. Obviously, we'll have this digital high seas series will continue with the last topic for this year, which will be done in the month of December on accounting and audit, business process outsourcing, which will be done by a esteemed member from our BPO team. So I look forward to all of you, attending that session as well. So thank you everyone for attending and have a good day.